Welcome to the deep dive. We're your shortcut to getting really informed, without drowning in all the data out there. Today, we're jumping into Lifezone Metals. That's ticker LZM on the NYSE. It's a high stakes, high reward kind of story. We've gone through the research, the articles, our notes, all the sources you sent. And we're trying to answer one big question. Could this company, with its proprietary tech and this big Tanzanian nickel deposit, actually deliver a cleaner supply chain for EVs? Okay, so here's the tension we found. Lifezone is basically betting on getting a green premium for its metals, but they're doing it right in the middle of a pretty tough nickel market, and they need a ton of capital.
Yeah, it's a bold strategy. Is it the future? Or is it just another promising project hitting some serious headwinds?
Exactly. And we're going to unpack this massive valuation gap we found. It's pretty fascinating, honestly. Might make you look at mining risk differently. Before we dive in, though, just a quick reminder, please do like and subscribe to the Lentriance YouTube channel. We cover all sorts of mining companies, and we really do take requests, especially if you're interested in precious metals stocks. Let us know what you're curious about. Okay, so our mission today, figure out if Lifezone Metals trading around, $4.32 as of August 9th, 2025, is a genuinely clean, future-focused bet in battery metals. We've broken this down into two parts. We'll start with the foundations. Let's kick off part one with chapter one, business analysis.
All right, first thing to get straight about LZM's a business. They're not actually mining anything yet.
Right. It's crucial to understand they are a development stage company.
So their business has, two main pillars, right?
Right.
And they seem connected.
They are. First is metals production. That's all about the Kabanga Nickel Project in Tanzania. The big ambition there is mine to metal. So not just digging up ore, but producing finished nickel, copper, and cobalt metals right there. Okay, finished metals in Tanzania. And the second pillar.
That's technology licensing and recycling. They own this proprietary tech called Hydromet Technology. Think of it as a cleaner, water-based way to process metals instead of traditional smelting, which, has a bigger environmental footprint.
Right, smelting can be pretty dirty. Is there an example of this Hydromet in action?
Yeah, a good one is their joint venture with Glencore over in the U.S. They're setting up a plant to recycle platinum, palladium, rhodium, the PGMs, from old auto catalysts.
Okay, so they're both a future metals producer and a tech provider. These pillars, they feed each other.
Exactly. The Hydromet tech is key to making Kabanga potentially cleaner, and if it works well there, it could boost licensing elsewhere. But let's really dig into the asset itself, the Kabanga Nickel Project. This isn't just a maybe anymore. They put out a feasibility study in July 2025. That's a huge step.
A feasibility study, so that's the detailed technical and economic plan.
Precisely. And importantly, it included their first declaration of mineral reserves.
Ah, reserves. Okay, remind us, how is that different from a resource?
Good question. A resource is an estimate of what might be in the ground. A reserve is a part of that resource they've proven. With high confidence, they can actually mine technically and economically. Big difference.
Got it. So what did this study say about Kabanga? Is it actually world-class?
The numbers suggest it is. We're talking proven and probable reserves of 52.2 million tons. And the grade is really the standout. Average 1.98% nickel. That's exceptionally high.
Exceptionally high. What's typical?
Well, most nickel sulfide deposits globally are, well under 1.5%, often closer to 1%.
Okay, so nearly 2% is significant. What else? Mine life. Production.
Estimated 18-year mine life, and there's potential to find more. They're projecting about 50,100 tons of nickel production per year, on average. But here's maybe the most impressive part. The projected all-in sustaining costs, the AISC.
AISC, that's basically everything it costs to produce and maintain the operation, right?
Exactly. And for Kabanga, it's projected at just $3.36 per pound of payable nickel.
Wow, $3.36. How does that stack up globally?
That puts it squarely in the first quartile of the global nickel cost curve, meaning it's among the cheapest projected operations in the world.
Okay, so super low cost, and that ties into their whole value proposition.
Directly. LZM wants to be this new independent supplier, offering, responsibly sourced, traceable, low-carbon battery metals, mainly for Western markets.
And they plan to produce LME-grade nickel, copper cathodes, cobalt rounds, actual finished metals. Why is doing that in-country so important?
It maximizes the value captured locally in Tanzania and for Lifezone itself. Plus, you avoid shipping lower-value concentrate, reducing transport costs and the carbon footprint that goes with it.
And the Hydromet tech fits in there too? Lower environmental impact?
That's the key pitch. It's designed for efficiency and a much lower environmental footprint. Crucially, it avoids the sulfur dioxide emissions you get from traditional smelting.
But can they really get a green premium for this cleaner nickel? That feels like the big unknown.
It absolutely is, and this ties right into the industry analysis and the commodity cycles. It's really interesting here. Look at nickel. It's currently stuck in a deep bear market, around $15,000 a ton. Why? A flood of supply from Indonesia, mostly pretty carbon-intensive stuff.
Right, tough time to be bringing a new nickel project online.
It is. But the forecasts all show a coming structural supply deficit, specifically for Class 1 nickel, the high-purity stuff needed for EV batteries. That deficit is expected by the end of the decade.
So the market might start differentiating clean nickel versus dirty nickel.
That's the bet LZM is making. Now, contrast that with copper. Copper's in a structural bull market, trading near $9,600 a ton.
Driven by the energy transition, right?
Yeah.
EVs, renewables, grids.
Exactly. Huge demand, and new supply is struggling to keep up. Then there's cobalt, more volatile, around $33,000 a ton. Oversupplied generally, but prices jumped recently when the DRC suspended some exports.
Green TGMs, the platinum group metals from their recycling JV.
They're doing well. Platinum is surging, maybe $339 an ounce, partly due to supply issues in South Africa. And looking ahead, hydrogen fuel cells could be a big demand driver for platinum.
Okay, so a mixed bag on commodities. Tough nickel market now, but maybe brighter future. Strong copper, volatile cobalt, good PGM prices. How does this mix affect a developer like LZM?
It's absolutely critical for financing. A long period of low nickel prices makes raising billions for construction incredibly hard, even with great project economics like Kabanga's.
Does the copper and PGM side help hedge that nickel risk?
A little bit, yeah. The PGM recycling venture with Glencore and the future copper revenues from Kabanga offer some diversification. But let's be clear, Kabanga's nickel is still the main engine driving the company's projected value.
Makes sense. What about competition? Who are they up against?
Well, in the nickel sulfide space, eventually it'll be the giants. Nornickel, Vale, Glencore, BHP. But right now, their main competition isn't for market share, it's for capital. They're competing for project finance dollars.
And the PGM recycling.
Smart move there. They partnered with Glencore instead of trying to compete directly with the big South African producers who dominate that space, leveraging Glencore's muscle.
Let's talk about Tanzania, the regulatory environment. You mentioned the Mining Act of 2019 gives the government a 16% non-dilutable free carried interest. Explain free carried for us.
Sure. Free carried interest means the Tanzanian government owns 16% of the project equity, but they don't have to contribute any capital for the exploration or construction costs. They get their share of future profits without the upfront investment risk.
So the government gets a stake for free, essentially. How does that affect the risk?
Well, it's fascinating, actually. It creates this really powerful alignment of interests. The government is directly incentivized to see the project succeed because they get a piece of the action. It can act as a buffer against things like resource nationalism, sudden tax hikes, or license issues because the government wins when the project wins. It potentially makes Tanzania more attractive than it might look just on the surface.
That's a really interesting angle. Okay, let's summarize their competitive advantage, their moat. It feels like two main things. First, cost.
Definitely, cost advantage. That high grade at Kabanga leads to the projected $3.36 AIC, puts them in the first quartile globally. That means they should make money even when others are struggling. Huge moat.
And second, the technology.
Right. Their unique capabilities via Hydromet. Environmental benefits, no SO2, lower carbon footprint, economic benefits, potentially lower costs, finished metal on site. And crucially, the strategic angle, the basis for that potential green premium from automakers needing clean, traceable metals, especially compared to that Indonesian stuff.
Okay, we've laid out the business case, the assets, the strategy. Let's shift gears to the people running the show. Time for Chapter 2, management evaluation.
Absolutely critical for a developer. You need the right team to pull off something this big. And the leadership assessment for LZM looks, well, pretty solid on paper. You've got Chris Showalter as CEO. He has this blend of Wall Street finance was at Goldman Sachs plus actual operational experience in Africa. That combination is vital for raising money and getting things done on the ground.
Finance and operations makes sense. Who else?
Then there's Keith Liddell. He's the founder, the chairman, the visionary, really.
Yeah.
Co-inventor of the Hydromet Tech. And very importantly, he's the biggest single shareholder, owns almost 30%, 29.3%.
Nearly a third. So his interests are definitely aligned with other shareholders.
Hugely aligned. His personal wealth is tied directly to the company's long-term success. Then you have Dr. Mike Adams, the CTO, also a co-inventor of Hydromet, 40-plus years in metallurgy. He's the technical brain.
Okay, the tech side is covered. Operations.
Yep.
Fine.
Yep. Garrett Bouton is COO, 25 years handling big, complex mining projects, specifically in emerging markets. He knows the territory. And Engel Hofmeyer is CFO, 20-plus years in global commodity finance, project finance, M&A. He knows how to structure the deals.
So you've got finance guys, tech guys, operations guys, and a founder with massive skin in the game. It sounds like a team built specifically for this challenge, right? Tackling the financing and the execution.
It certainly seems designed that way. You need the finance expertise for the funding, the operational know-how for the build and local realities, and the technical depth for the proprietary process. It looks like a well-rounded team for the task ahead.
Okay, let's look at capital allocation. Since they're pre-revenue, it's all about investment, right?
Exactly. All capital goes into de-risking and advancing the projects. In fiscal 2024, they spent about $52.7 million on investing activities, and the vast majority of that, $50 million, went straight into Kabanga.
How are they funding this?
They raised about $48.4 million, partly through convertible debentures, that's debt that can turn into equity later, and also from the Glencore JV setup. And a really key strategic move was buying out BHP's stake in Kabanga. That gave LZM 100% control, which simplifies decisions and, importantly, means they control 100% of the future metal sales, the offtake.
Makes sense. And obviously no dividends or buybacks at this stage.
No, definitely not. Every dollar has to go back into building value. That's normal for a developer.
And you mentioned metrics like ROIC aren't really useful here.
Right. A negative ROIC like negative 18.98% is expected when you're spending heavily before generating revenue. The number you should look for in their technical studies is the project's projected after-tax IR, the internal rate of return. That tells you the potential profitability once it's running.
Got it. Okay, let's move on and dive into the numbers they do have. Time for Chapter 3, Financial Analysis.
Right. And remember, when looking at these financials for a developer, it's about future potential and current stability, not profits yet. Data is mostly as of December 31, 2024. So key metrics. Market cap around $325 million as of early August 2025. Revenue, tiny, $141,000 in FY 2024. Expected?
And profitability. Losses, I assume.
Deep losses. Net loss was $46.3 million, or about 59 cents a share. Again, totally normal for this stage. Cash flow is also negative. They burned through about $68.6 million in free cash flow in 2024 between operations and CapEx.
Okay, so the key question for financial stability isn't earnings. It's, do they have enough cash? What's the balance sheet look like?
Exactly. Their debt-to-equity ratio is okay, manageable at 0.28, but the current ratio was 0.57. That's below 1.1.
Current ratio below 1 means short-term assets don't cover short-term liabilities, right? Indicates some pressure.
Precisely. They had about $29.3 million in cash at year-end 2024. It just underscores how critical it is for them to secure that next tranche of major financing. Their runway isn't infinite.
And dividends are clearly years away, if ever.
Years. All cash needs to go to the project.
Okay, on to valuation analysis. Traditional metrics like PE are useless. So how do we value this? Based on the assets.
Correct. You look at the potential future value. One relative metric is price to book, PB. It's 3.82. So the market values the assets at nearly 4 times what's on the books, suggesting some optimism.
But the main valuation method is based on the project's future cash flows.
Yes, the intrinsic valuation using a net asset value NAV approach. This comes from a discounted cash flow DCF model of the mine. You basically project all the revenues and costs over the mine's life, discount those future cash flows back to today's value using a discount rate, say 8%, to account for risk and time, and that gives you the net present value, NPV.
Okay, so what's the NPV for Kabanga?
The feasibility study calculated the after-tax NPV at an 8% discount rate to be $2.37 billion on a 100% project basis.
But Lifezone doesn't own 100% because of the government's 16% stake.
Right, Lifezone's effective interest is 84%. So their attributable share of that NPV is roughly $1.99 billion.
Okay, $1.99 billion attributable NPV. Now connect that back to the market cap. This is the gap, right?
This is a huge gap. Market cap currently around $325 million. Attributable NPV around $1.99 billion. That means it's trading at a price to NAV ratio of about 0.16, 16 cents on the dollar.
Wow. So the market is applying an 84% discount to the analyst's view of intrinsic value. Why such a massive discount? What specific risks are baked in there?
It's primarily pricing in the financing risk. The market sees that $1.99 billion potential, but it's saying, show me the money to build it. Until that multi-billion-dollar project financing is secured, the value is still largely theoretical in the market size. Beyond financing, it's also pricing in execution risk, the very real possibility of construction delays, cost overruns, ramp-up problems. And there's always a discount for perceived geopolitical risk in Tanzania, even with the government partnership helping align interests.
So buying LZM now is essentially a bet that management can navigate those risks and close that value gap.
That's exactly the bet. It's a bet on de-risking.
All right, we've covered the business, the management, the financials. Let's see how the broader market is reacting. That brings us to part 2. Kicking off part 2 with chapter 4, market sentiment.
Yeah, and the sentiment is, well, it's split. There's this really stark contrast between what analysts are saying and what the stock price is doing. The analysts who cover LZM, they're uniformly positive. The consensus is a strong buy.
Strong buy. What are their price targets looking like?
The average one-year target is somewhere between $9.50 and $10.84. Some go as high as $13.12. The lowest is still $8.
Okay, so analysts see potential for the stock to double or even triple from its current $4.32 price. That's a huge disconnect.
Massive. Analysts are basically valuing it much closer to that NAV we discussed, while the market is slapping that big risk discount on it.
What about recent news? Has that helped?
The news flow has been generally neutral to positive, mostly driven by the company's own announcements, the feasibility study, the mineral reserves, buying BHP's stake. The narrative is consistently the cleaner metals for the energy transition story.
And looking at specific market indicators, what's the short interest like? Are people betting against it?
The short interest is moderate. About 1.21 million shares shorted, which is around 4.3% of the shares available for trading. That translates to about 7 to 9 days to cover, meaning how long it would take shorts to buy back shares based on average volume. It suggests some skepticism, likely focused on those financing hurdles and the weak nickel price.
And technically, where's the price sitting relative to key averages?
It's just slightly above its 50-day moving average, $4.29, but still well below its 200-day moving average, $5.17.
Okay, so the technical picture suggests it might be trying to find a floor, maybe building a base here, but the longer-term trend is still down until it can convincingly break above that 200-day average. Market's still cautious.
That sums it up well. Hesitation.
All right, let's look inside the company. Who actually owns LZM? Does the ownership structure tell us anything strategic? Let's move to chapter 5, ownership structure.
The ownership here is actually quite telling. It's highly concentrated, which usually signals strong alignment. First, institutional ownership. About 19.3% is held by big players, names like BlackRock, GMO, Sprott Inc.
Having those sophisticated investors involved definitely adds some credibility, doesn't it? They do their homework.
Absolutely. Their presence suggests they see value, despite the risks. But even more significant is the insider holdings. Insiders collectively own a controlling 53.8% of the company.
Over half owned by insiders. Wow.
Yeah, and remember, Keith Liddell, the founder and chairman, he alone holds 29.3%. CEO Chris Showalter has 4.3%.
Okay, so management's personal fortunes are deeply, deeply tied to making this work long term. Have they been buying or selling recently?
No open market buys or sells reported in the last 12 months. That's pretty typical for insiders at this development stage. They're focused on hitting project milestones, not trading shares.
Makes sense. What about other strategic owners or partners?
Very important here. We already talked about the government of Tanzania with its 16% free carried interest in the project itself. That makes them a vital strategic partner. Then you have the industrial partnerships. The JV with Glencore on PGM recycling isn't just about recycling. It's technical validation from a major player and a powerful commercial relationship. There's also a memorandum of understanding with Hydromet, the Japanese state entity. That signals potential future financing or, importantly, off-take agreements for the metals.
Off-take agreements, securing buyers in advance. And LZM now controls all the offtake from Kabanga since the BHP deal.
Yes, they control 100% of the offtake rights. That gives them complete strategic control over who buys their nickel, copper, and cobalt, and potentially allows them to negotiate those green premium deals directly.
Okay, so ownership is concentrated, insiders are heavily invested, and they have key government and industry partners. Seems like a strong setup.
It definitely points towards alignment and strategic positioning.
We've looked at the company, the market, the owners. Now let's consolidate the potential upsides and downsides. Time for Chapter 6, risk assessment using a SWOT analysis.
Okay, the SWOT strengths, weaknesses, opportunities, threats. It really frames the LZM story well. World-class potential facing major hurdles. Let's start with strengths, top of the list. The world-class asset, Kabanga, large, high-grade nickel sulfide. Second, the proprietary technology, Hydromet, offering cost and environmental pluses. Third, the project is significantly de-risked now with the positive feasibility study and declared reserves. Fourth, that low-cost potential first quartile AISC is huge. Fifth, aligned management thanks to that massive insider ownership. And sixth, the government partnership in Tanzania, which helps mitigate political risk.
Okay, those are some compelling strengths. What about the flip side? The weaknesses?
Biggest one, pre-revenue status. They burn cash and depend entirely on outside funding right now. Second, single asset concentration. So much value is tied up just in Kabanga. Third, that liquidity risk we saw with the current ratio below 1.0. They need cash. Fourth, while Hydromet is promising, it's still technically unproven technology at the scale required for Kabanga. The recycling JV helps, but Kabanga is a much bigger test. All right, strengths and weaknesses clear. What opportunities can they seize? Huge ones. The structural demand growth for battery metals from the energy transition is a massive tailwind. The potential to actually achieve a green premium price for their cleaner metals is a major opportunity. Also, technology commercialization. If Hydromet works well, they could license it more widely, maybe beyond the Glencore JV. And finally, resource expansion. They could potentially find more nickel at Kabanga, extending the mine life. Okay, lots of upside potential. But what are the biggest threats that could derail this? Number one, without a doubt, is financing risk. Getting those billions for construction is the major hurdle. Failure here stops everything.
Especially with nickel prices currently low.
Exactly. Yeah. Which leads to threat number two, commodity price volatility. A prolonged nickel slump makes financing much tougher. Third is project execution risk. Building giant mines is complex. Cost overruns, delays, ramp-up problems are common threats. Fourth, geopolitical and regulatory risk. Even with a government partnership, Tanzania is still a developing nation. Things can change. And fifth, broader macroeconomic factors, a global recession, high interest rates could hit metal demand and raise capital costs.
That lays out the battlefield pretty clearly. World-class asset, innovative tech, great cost profile versus massive financing needs, execution risks, and market headwinds. We've covered a lot of ground. Let's bring it all together. Final thoughts in Chapter 7, conclusion.
Okay, so synthesizing all this, LZM really is that classic high-risk, high-reward mining developer story. The bull case rests on owning this de-risked, world-class Kabanga asset, high-grade, low-cost, perfectly positioned for the energy transition. Add the ESG advantage from Hydromet, potentially unlocking that green premium. You've got strong insider alignment, the Tanzanian government as a partner, and critically, it's trading at maybe 16% of its attributable NPV. That implies massive upside if they execute.
But the risks are just as significant. What's the core bear case?
Immense financing challenges. Getting billions is never easy, especially in a weak nickel market. Huge execution risk building a complex project in Africa. They're pre-revenue, liquidity is tight, totally dependent on capital markets. There's still jurisdictional risk, despite the partnership, and almost all the value hinges on just one asset succeeding.
So that valuation gap, the $325 million market cap versus the nearly $2 billion attributable NPV, that's the market essentially pricing in the probability of failure on those financing and execution fronts.
That's precisely what that discount represents. It's the market saying, prove you can build it.
So the investment thesis boils down to a potential re-rating as they hit milestones and de-risk further.
Exactly. Let's think about scenarios. Base case scenario. Metal prices are okay. They secure project financing on decent terms in the next year or so. They build the mine mostly on time and budget. If that happens, the discount to NAV should narrow, and the share price could move up towards those analyst targets.
Okay, what's the dream scenario? The bull case scenario?
Nickel market recovers strongly. LZM signs premium offtake deals proving the green value. Project economics look even better. Financing is easier. They execute flawlessly on Kabanga, and the PGM recycling JV expands. In that world, the share price could absolutely converge towards or even exceed the NPV.
And the nightmare, the bear case scenario?
They failed to secure financing. Maybe nickel stays low. Maybe if investor appetite dries up, the project gets shelved indefinitely. They might have to do very dilutive equity raises just to survive, burning through cash. That could lead to substantial, potentially total loss of capital for current investors.
A stark range of outcomes. This deep dive really highlights the complexities and the capital intensity behind the energy transition metals we need. It leaves you with the big question. Given everything, the world-class asset, the tech, the potential premium, but also the huge financing hurdle and execution risk, do you think that potential is enough to overcome the market's deep discount? Or are the risks just too high for a developer like this right now? Definitely something to think about. Well, we've covered a lot today on Lifezone Metals, the good, the bad, and the uncertain. Make sure you subscribe to the stockanalytics.ai YouTube channel to stay on top of future deep dives like this one. And remember, if you're a member, you can suggest stocks for us to cover in the comments. We do look at those. And if you found this valuable today, please take a moment to rate, review, and subscribe wherever you listen to your podcasts. It really helps other people find the show. Disclaimer. Just a reminder, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be taken as financial advice. Always do your own research or talk to a qualified financial advisor before making any investment decisions. This deep dive relied on extensive research and data synthesized by an AI system.